Are your investments safe? The global markets are flashing red as President Trump doubles down on tariffs. We're not talking about a minor dip. We're potentially staring down the barrel of a full-blown trade war. This isn't just about economics. It's about your future, your retirement, and the stability of the global economy. Did you know that a recent study by the Peterson Institute for International Economics found that a 25% tariff on all imports could reduce U.S. GDP by 1%? That's trillions of dollars. Get ready, because things are about to get bumpy. President Trump has officially imposed tariffs, a 25% levy on goods from Canada and Mexico, and a 10% tariff on Chinese imports. He argues this is necessary to protect American jobs and curb illegal immigration and drugs. But is it really that simple? He even stated in a recent tweet that tariffs cause success, but the data tells a different story. These tariffs are not just numbers on paper. They are taxes that will be passed on to consumers, impacting everything from the price of your groceries to the cost of your car. The market reaction has been swift and brutal. The Canadian dollar plummeted to a two-decade low. The Mexican peso hit a four-year low. The euro took a major hit, plunging more than 1% against the dollar. Commodity currencies like the Australian and New Zealand dollars are also feeling the pain. It's a bloodbath out there. Even Bitcoin, the darling of the crypto world, has taken a nosedive. Investors are running scared, and they're heading for the exits. This isn't just a correction, it's a panic. Canada, Mexico, and China are not backing down. They're gearing up to fight back with their own retaliatory measures. Canada is imposing 25% tariffs on U.S. goods worth 155 billion Canadian dollars, targeting everything from alcohol to agriculture. Mexico is working on a Plan B, involving both tariff and non-tariff measures. And China is threatening to file a lawsuit with the World Trade Organization. This is escalating quickly. We're talking about a tit-for-tat battle that could cripple global trade and trigger a recession. Economists are sounding the alarm. Deutsche Bank warns of immediate recessionary consequences for some of the economies involved. Capital Economics predicts that the tariffs could plunge Canada and Mexico into recession later this year. This isn't just about trade. It's about jobs, livelihoods, and the overall health of the global economy. Are we headed for another financial crisis? The signs are certainly worrying. The automotive industry is particularly vulnerable. European car manufacturers with Mexican plants, like BMW, are facing a volatile session. The intricate supply chains that crisscross borders are being disrupted, leading to higher costs and potential production delays. This isn't just about luxury cars. It's about the everyday vehicles that millions of people rely on. Get ready to pay more for your next car or truck. Government bond yields are under pressure. While long-term government bonds are often considered safe haven assets, Trump's tariffs and the threat of retaliation could intensify global inflationary pressures, potentially disrupting central banks' easing cycles. This means higher borrowing costs for everyone, from governments to business. Harvard economics professor Lawrence Summers warns that the tariffs against Canada and Mexico are inexplicable and dangerous. He argues that much of what we export involves imported inputs, making the whole of North America much less competitive. This isn't about protecting American jobs. It's about shooting ourselves in the foot. The tariffs will lead to higher prices, reduced competitiveness, and ultimately, a weaker economy. China plans to file a lawsuit with the World Trade Organization, arguing that the tariffs seriously violate WTO rules. This is a high-stakes legal battle that could take years to resolve. But even if China wins, the damage may already be done. The WTO is a slow-moving bureaucracy, and it may not be able to effectively address the rapidly escalating trade war. Is the WTO even relevant in this new era of protectionism? So what can be done? The first step is to de-escalate the situation and engage in meaningful negotiations. Trump needs to understand that tariffs are not a magic bullet. They are a blunt instrument that can have unintended consequences. We need to find a way to address legitimate concerns about trade imbalances and unfair practices without triggering a global trade war. This requires diplomacy, compromise, and a willingness to listen to all sides. For investors, the key is diversification and risk management. Don't put all your eggs in one basket. Spread your investments across different asset classes and different countries. And be prepared to weather the storm. This is not a time to panic. It's a time to be cautious and strategic. Consider consulting with a financial advisor to develop a plan that is tailored to your individual needs and circumstances. Businesses need to build more resilient supply chains. This means diversifying their sources of supply and reducing their reliance on any single country. It also means investing in technology and infrastructure to improve supply chain visibility and agility. The old model of just-in-time manufacturing may no longer be viable in a world of trade wars and geopolitical uncertainty. We need to embrace a new model of just-in-case resilience. The future of trade is uncertain. But one thing is clear, the world is changing. We are moving away from a system of free trade and globalization towards a more fragmented and protectionist world. This presents both challenges and opportunities. We need to adapt to this new reality and find ways to navigate the risks and capitalize on the opportunities. The stakes are high, and the future of the global economy is on the line. Now, let's get a bit technical. One of the key economic concepts at play here is the Phillips curve. Traditionally, it shows an inverse relationship between inflation and unemployment. However, Trump's tariffs could disrupt this relationship. The tariffs might lead to higher inflation due to increased import costs, but they might not necessarily decrease unemployment. This could lead to a stagflationary environment, a scenario economists dread. We're potentially rewriting the rules of macroeconomics here. Another concept to consider is the J-curve effect. This theory suggests that a country's trade balance will initially worsen after a currency devaluation, or in this case, the imposition of tariffs, before it improves. This is because import prices rise immediately, while export volumes take time to adjust. So, even if Trump's tariffs are intended to improve the trade balance, we might see it worsen in the short term. Are we prepared for the initial dip before the potential rise? Finally, let's talk about the Heckscher-Lean theorem. This theorem states that countries will export goods that make intensive use of locally abundant factors of production and import goods that make intensive use of factors that are locally scarce. Trump's tariffs are essentially trying to defy this theorem by artificially altering the relative prices of goods. This could lead to inefficiencies and distortions in the global economy. Are we interfering with fundamental economic principles? Now, let's look at some conflicting viewpoints. Some argue that Trump's tariffs are a necessary evil to protect American industries and jobs. They believe that the long-term benefits will outweigh the short-term pain. On the other hand, many economists argue that the tariffs are a self-inflicted wound that will harm the American economy. They point to the potential for higher prices, reduced competitiveness, and retaliatory measures from other countries. So who's right? The answer is not clear-cut, and the debate is likely to continue for months to come. A recent paper published in the Journal of International Economics titled The Trade War and the U.S. Economy by Fagelbaum, Goldberg, Kennedy, and Candelwall provides empirical evidence suggesting significant welfare losses for U.S. consumers due to the tariffs. How can we test these conflicting theories? One approach is to analyze the actual impact of the tariffs on prices, employment, and trade flows. We can track the prices of imported goods and compare them to the prices of domestically produced goods. We can monitor employment levels in affected industries. And we can analyze trade data to see how the tariffs are affecting the volume and composition of trade. This is a data-driven approach that can help us to separate fact from fiction. Another approach is to use economic models to simulate the impact of the tariffs under different scenarios. These models can help us to understand the potential long-term consequences of the tariffs and to identify the most effective policy responses. But remember, all models are simplifications of reality, and their predictions should be taken with a grain of salt. The trade war is a complex and evolving situation that has the potential to impact all of us. So what should you do? Stay informed, be prepared, and don't panic. And most importantly, let your voice be heard. Contact your elected officials and tell them what you think about the tariffs. The future of the global economy is in our hands. What do you think? Leave a comment below and let's start a discussion. Don't forget to subscribe for more updates on this critical issue. Your insights are valuable, and together, we can navigate this challenging landscape. Are you ready to take action?